Welcome back. The week on Wall Street started with Manic Monday, where investors saw the Dow plunge 1,000 points. The markets then surged Tuesday, followed by more plunging and surging throughout the week. Mark Zandi is chief economist at Moody Analytics. Mark, what happened this week?
Oh, wasn't it a wild ride? Yeah, on Monday morning.
It's like the Trump campaign.
Oh, yeah. Not quite as wild as that, I don't think. Well, you know, the stock market has come a long way in a very short period of time. It's, believe it or not, if you go back to the bottom after the recession and go to the very peak, the all-time peak this summer, the market has almost tripled in value. And that's an amazing bull market. So it's not at all surprising that you would see a correction like this. And, clearly the script is still being written here. But my sense is that this is what you might call a garden variety stock market correction.
Now, if I'm out in the listening audience, what does a garden variety stock market correction mean for me if I've got money in the market, and what should I be doing or not doing?
Nothing. It means you should do nothing. You shouldn't panic. If you're in the stock market, if you're invested in the stock market, you shouldn't be invested for a month, a quarter, for a year. You should be looking out over a 3, 4, 5, 6 year horizon. And the market goes up, it goes down, it goes all around. But at the end of the day, if the economy is on solid ground, the stock market will rise and you'll be fine. So there's nothing you should do in response to this. Now, of course, we've got a lot of baby boomers out there. They're in their 50s and 60s. Their horizons, their investment horizons are now shortening because they're approaching retirement. So they should go back and take a look at their portfolios and make sure they're not overladen with stock.
Two kinds of economies here. There's the U.S. economy, which we'll get to in a minute. But this set of gyrations was set off by the economy in China, right? What's going on there, and how worried do U.S. investors have to be about that?
Well, it's clearly slowing. It is now experiencing the slowest rate of growth in 25 years in China. There's a lot of debate about to what degree it's slowing, just because the data is not very good. And that's part of the problem. It's such an opaque country. We really don't have good data. We don't have a good grip on it. That makes everyone very nervous. So it's clearly slowing. You know, my sense is they have the resources and they have enough control over the economy that it's not going to be really graceful, but at the end of the day, they'll hit their growth targets, at least over the next couple, 3 years, and it shouldn't be too much of a problem for the global economy and our economy. But you put your finger on the most significant threat to any optimism. It's what's going on in China.
So what about, how optimistic should we then be about the American economy? What's its state of affairs?
Okay, John, I'm optimistic. Look, the best way of gauging the health of the American economy is jobs. That's what people care about the most. And this economy created nearly 3 million jobs over the past year. Just to put that into context for you, the last time that happened was in 1999 in the teeth of the technology boom. And then we had a tech bubble. There is no bubble today. So this is on very solid foundations. And when you create 3 million jobs, yeah, you're creating a lot of low-paying jobs, no doubt. But you're creating all kinds of jobs, high-paying jobs, middle-paying jobs, really across the board. And as long as that continues, and there's no sign that's slowing, I think our economy is going to be fine.
The last question I want to ask you is, people are going to hear a lot about the Federal Reserve and what it's doing. What should they think about the Federal Reserve and what to look for going forward?
For most people, it really is this bit of a parlor game. For people in the markets and economists like me, it's something like, geeks really get into. When are they actually going to raise interest rates? But the policymakers at the Federal Reserve have said over and over again that when they start to raise interest rates, they're going to raise them very, very slowly and let the economy adjust. And so that allows all of us to adjust. And one last final thing I'd say, a 0% interest rate, that's where interest rates are today. That is not a sign of a healthy economy, right? It's a good thing if interest rates rise and get back to something more typical, 3, 4% for a federal funds rate target. And if we get there over the next 3 or 4 years, that's a very good sign that our economy is moving in the right direction.